Hi, it's Jeff here. Welcome to the channel. Today we're going to dive into the UK's looming recession risk for 2025. We'll cover key factors like stagnating GDP, fragile consumer confidence and rising unemployment, and how will these challenges shape the economy, and is a recovery on the horizon? So stick around, let's unpack the data. Well, lots of newspaper headlines in recent days about the weakness of the UK economy as we reach the end of 2024. The FT headline reads New Year challenge laid bare as economic growth grinds to a halt. And the Independent, UK businesses brace for economic gloom. Indeed, it seems there is a growing range of factors suggesting the UK economy is faltering and perhaps on the edge of sliding into another recession. And as we'll see, the budget back in October, the first budget from Chancellor Rachel Reeves, seems likely to be a big factor, increasing business costs and driving increased uncertainty as we head into the new year. And millions of households still remain under great financial pressure. And many people on average and below average incomes have extremely limited savings to act on as a buffer. And some sectors of the economy are particularly vulnerable to what's about to happen. So labour-intensive sectors, including retail and hospitality, that employ hundreds of thousands, millions of relatively low-paid workers, they may see a contraction in employment next year. Indeed, a rise in unemployment seems inevitable, but will it be enough to cause a recession? And when it comes to interest rates, it seems to be the case that the Bank of England will be much less aggressive in cutting interest rates than people had expected a few months back. So first of all, here's the data on GDP. The GDP index measures the level of real GDP, national income adjusted for inflation. And monthly GDP, as you can see, appears to have stagnated. There's no clear upward momentum. Indeed, in the last few months, GDP has been edging lower. And the lack of recovery points to wider structural supply-side challenges, including high borrowing costs, weak investment and low consumer confidence. Here's the chart showing consumer confidence as an index, and a score of 100 on the left-hand side there represents the long-term average, with scores above 100 indicating sort of stronger, greater confidence. And you can see that it's now below 100 and is falling in recent months. There's also an index called the Purchasing Managers Index, or PMI, and this is derived from surveys of purchasing managers, bizarrely enough, across manufacturing and service sectors. So this is where a manufacturing business like a car maker could be buying component parts, or the hotel and hospitality sector could be buying the things that hotels need to use on a daily basis. And a value above 50 indicates an expansion in the economy, a value below 50 signals contraction. And as you can see, the Purchasing Managers Index in recent months has been declining towards 50, and that suggests the UK is teetering between stagnation and contraction as of late 2024. Unemployment is already starting to rise. As you can see, since the summer of 2022, it has edged higher, currently at 4.3% of the labour force. Youth unemployment is now at 13.9%. And rising unemployment and falling vacancies are signs of a softening or weakening of the labour market, which again often leads to a fall in consumer spending. If people are out of work, they don't have the financial resources to cope. And look at this chart showing job vacancies. It's a lead indicator of the labour market. So high vacancies suggest strong labour demand. Low vacancies suggest firms are cutting back on hiring or holding back on taking on new workers. Now, the number of vacancies is very sensitive to economic conditions. We saw the steep rise as the economy tried to lift itself out of the pandemic. And the story in 2022 was huge labour shortages in key sectors. But it's now fallen. It's now back to 818,000. And let's see if that continues to fall as we head into next year. Now, the minimum wage is part of the story here, I think. It was introduced in 1999, so 25 years ago. £3.60 initially, and as you can see, the minimum wage has seen steady growth, faster increases in recent years as governments have responded to the cost of living crisis. Now, as we head into 2025 in the spring, the adult rate will go up to £12.21, and there's only 3 rates now. Those continued increases will offer a boost to the incomes of many low-income workers, but it's an added cost to businesses in labour-intensive sectors. And then we add in the consequence of the national insurance hike. So go back to October 2024. Rachel Reeves announced a big increase in taxes, 41 billion rise in tax, designed in part to fill the black hole that she discovered when she came to office. The biggest tax increase in the budget last year was the rise in national insurance. Now, this is paid by both employees, that didn't change, but also by employers, firms, businesses. So the rate of national insurance paid by employers on their workers' earnings is increasing from 13.8 to 15%. Not only that, there's a decrease in the threshold after which employers start paying those taxes. So you now will start paying national insurance if people who you employ earn more than £414 a month, down significantly from £758 a month. So this is the biggest tax increase in the budget. It's going to raise probably somewhere around £25 billion in each of the next 2 years. But it is a tax on employment. And this is a deliberate choice taken by the government. They hemmed themselves in by saying they wouldn't increase VAT, they wouldn't increase national insurance on employees, and they wouldn't increase income tax. So therefore they decided to go with this national insurance rise for businesses. The big uncertainty, the big question let's want to really think about as we head into next year is the impact this is likely to have on employment, particularly in labour-intensive sectors. Now, real wages are starting to rise again. The blue line here shows wage growth. The grey line shows inflation. So wages are rising above inflation, which is good news for those people in work, and that will help sustain demand and sustain growth in the economy. But inflation is now back above target. CPI inflation in November, the data came out a little while ago, a few days ago, it was 2.6%. Second month in a row it's gone up. Of course, CPI measures the rate of change of prices, not just of one thing, but a basket of goods and services over time. Core inflation, excluding food and energy, is 3.5%. Overall inflation is 2.6%. And you can see sectors like alcohol, health, education, communication, those sectors are seeing inflation of 4% or more, whereas furniture, household equipment and maintenance actually prices falling. Services rising in price by 5% on an annualised basis, goods just 0.4%. But inflation is now back above target. And I guess the fear is, as we head into 2025, is that the inflationary pressures will start to pick up again, maybe towards 3%. In which case, the Bank of England will possibly be less likely, a bit more reluctant, to keep cutting interest rates. This is the bank rate or base rate. It's the interest rate at which commercial banks, such as Barclays and NatWest, borrow or deposit funds at the central bank. Now, you can see that big rise in base interest rates from 2021 onwards as the Bank of England responded to the rise in inflation. They started to cut interest rates in the summer. We're now down to 4.75%. And I think the prospect is that the Bank of England will cut interest rates as we head into 2025, but perhaps not quite as quickly and as deeply as people might have been expecting. Paradoxically, if we go into a recession, which is increasingly likely, then the bank may indeed start to cut interest rates a little quicker. So there we go. Really interesting situation facing the UK economy at the moment. How will these challenges of higher business costs shape the economy? Stick around with us on Tutor to You to unpack the data and explore what lies ahead for the UK. We'll produce regular updates on the UK economy to help with your economics revision. Stay happy, stay healthy, stay curious, and see you all sometime soon.